Hello, my name is Victoria Koch. I'm an accounting instructor for South Dakota State University. Thank you for joining us today for Tax Talk through South Dakota State University Extension. Today, we are going to focus on Schedule C filings. Small business owners need to understand the tax deductibility of certain expenses and the implications that has in your business planning. For instance, some expenses are not deductible to the same extent that they would be deduct from your income on your financial reporting. Therefore, your net income on your financial reports is never going to match the net income on your Schedule C filings. And this can throw small business owners off. And it's very important that you understand these different implications in order to manage your business expenses, grow your business, and get the best tax planning possible. So to start, let's talk about what is a business. The IRS doesn't specifically define a business. Instead, they consider any activity that is conducted for profit to be a business, and therefore you need to report your net income. That can include different hobbies and anything that's going to generate revenues to you as an individual. Now, the IRS states that you need to report all income from any sources derived, but as far as the expenses that can be deducted against that income, there are some limitations. Expenses have to meet several tests in order to qualify as a deduction, and in general, there are 3 of them. The first one, the expense has to be ordinary and necessary. So it's the type of expense that's commonly found in your business, or it's helpful and appropriate in running the business. For example, a CPA who is busy with tax season may attend a conference to get up to date in tax law or tax changes and prepare themselves for the busy tax season ahead. That would be considered an ordinary and necessary business expense. However, if that CPA joins a gym to build their endurance to make it through that tax season, that is not ordinary and necessary in their line of work. The second general test to determine deductibility of a business expense is that it has to have a legitimate business purpose. For instance, you may need to build an office space in order to meet clients and conduct your business. However, if you're that CPA and you spend $75,000 to construct a glass sunroom for your orchids and put them on display, that may not be considered a legitimate business purpose for that expense. And finally, the expense has to be reasonable in light of the fees that are generated as a result of the expense. If you have a client who generates $10,000 a year in revenue for your business, it's not considered reasonable that you would have $20,000 a year in entertainment expenses related to that client. So for today's discussion, I have chosen some of the various topics of expenses that have different nuances in their deductibility and some of the rules that business owners commonly misunderstand and that are often confusing to small business owners. The first is transportation expenses. It's never as simple as deducting expenses related going to and from clients' offices. Definitely you can deduct certain transportation expenses, but there are some limitations. For instance, commuting is never deductible. If you're a small business owner and you have an office space, going from your home to that office space is not a deductible expense. However, there are some exceptions, as there is to much of tax code. If you're traveling from home and work between locations outside the metro area where you have your regular place of business, that travel is considered deductible expense. For example, if your main office is in Sioux Falls, but you also have an office in Rapid City, and once a month you have to travel from Sioux Falls to Rapid City just for a couple of days for work, that transportation expense may be deductible because it's outside of your normal metro area where you live and work. The other exception is traveling between home and temporary work from your regular place of business. If you, in that same situation, instead of Rapid City, if you had another office in Harrisburg, and from time to time you had to travel to Harrisburg, be it even for a couple hours a week, that travel may be deductible. However, if you have those 2 offices and you split your time between the 2, and the Harrisburg office also becomes your regular place of work, that would not be deductible. And finally, when your principal place of business is your home, any travel to see clients, to go on business calls, any of that would be considered deductible. If you are in a line of work where you need to haul tools or equipment, any of the costs associated with hauling any of that is also part of your transportation deduction. There are two different methods by which you can deduct transportation expenses. There's the standard mileage deduction or the actual cost deduction. In the standard mileage deduction for the year 2012, that deduction is 55.5 cents per mile. You need to keep track of how many miles you actually travel for business purposes, and then use the mileage rate for your deduction. Now, this amount can change from year to year, and sometimes it has changed in the course of a year, so you need to make sure you consult irs.gov or your tax consultant for your current rate. Now, the standard mileage rate does not apply to parking, tolls, and personal property taxes or auto loan interest for the business portion. Those are 100% deductible costs. In order to use the standard mileage deduction, there are some conditions. You need to own or lease the car. You cannot rent that car out as part of your business use. You cannot have a fleet using 5 or more autos simultaneously, such as a car service. You cannot take depreciation other than straight line, and you cannot have taken Section 179 depreciation on auto. Section 179 depreciation allows you to depreciate more up front of the vehicle, or perhaps 100%, and consult your tax advisor for more information on that. If you do not qualify for the standard mileage deduction, or if you do not choose the standard mileage deduction, your other option is actual cost deduction. If you use actual cost, you cannot change to standard. However, if you use standard, you can change back to the actual cost deduction, but then you will not be able to return to standard at a later date. So in the first year of operations, you may want to choose the deduction that gives you the highest benefit. It's all about record keeping with the IRS. You need to make sure that you keep adequate records. That includes keeping a mileage record in your vehicle, putting down your starting miles when you leave your home or office, and including your ending miles when you reach your destination to determine the total amount of miles driven. You also want to put the business purpose of the travel in your log. For the actual cost record, you want to determine how much of your miles driven was for business use. A lot of small business owners have one vehicle that they have to split between personal and business use. And this log helps you keep that record and understand what percentage of use is for business purposes. The actual expenses that you can deduct include gas, oil, repairs, maintenance, depreciation, personal property taxes if applicable, and interest on the car if you have a car loan. Now, maintenance can include anything from getting your oil changed to a car wash, so you want to keep receipts for all of these types of expenses. There are some business-related items that are fully deductible, and you don't have to use the business use percentage, and those include parking or tolls for business purposes. If you work for someone else and you are unable to deduct these types of expenses on a Schedule C, you may still be able to deduct transportation expenses on Schedule A if they are unreimbursed by your employer. Entertainment. Entertainment expenses, meals and entertainment, are often an important part of business expenses, but what small business owners don't realize is that only 50% of the total cost is actually deductible on your tax return. All small business owners are going to deduct 100% of the expense on their financial reporting, but really only 50% is deductible for tax purposes. The entertainment has to be either directly related to or associated with your active conduct of business. For example, lunches provided during an actual business meeting or events immediately following or prior to a business meeting can count as meals or entertainment. You can include a variety of different activities, such as sporting events or concerts, and actual meals. But again, they're only deductible at 50%. If you use an entertainment facility, such as a club or a yacht, you're very limited on what's deductible. Country club expenses generally are not deductible. However, paying for a golf outing with a colleague is deductible. If you have a yacht and you host an event on the yacht, the cost of the entertainment itself may be deductible, but the yacht is not. Another topic that small business owners are often concerned with is the deductibility of special clothing and uniforms. Uniforms and special clothes are only deductible if they're required as a condition of employment and cannot be worn outside of work. The accountant who wears business suits to work every day and requires their employees to wear business suits every day cannot deduct the cost of those suits. They are considered to be able to be worn outside of work and therefore do not fit the requirement. Any t-shirts or sweatshirts that have your business logo and that you require employees to wear also would not be deductible because they can be worn outside of work. However, protective wear is always deductible, so items like safety goggles, safety shoes, hard hats, those types of things would be deductible business expenses. Office in the home is often one of the most confusing topics for business owners. A lot of small businesses get their start from the owner working right out of their home, and they want to deduct the use of that property as part of their business expenses. The IRS actually states that homes cannot be deducted for business purposes, so the deduction is allowed only by exception, and there are a few exceptions. So the home has to be used regularly and exclusively as a principal place of business or required for the convenience of the employer when the regular office is not provided. What that means is you have to have a dedicated space for your business. The key is the word exclusively. You cannot use that space for any other purpose. Maintaining inventory in one of your kitchen cabinets does not allow you to deduct your kitchen as office in the home. Hosting events related to your business in your family room does not allow you to deduct your family room as office in the home because it can also be used for other purposes. However, if you have a separate bedroom that you've converted into an office where you meet clients, things like that, that can be considered office in the home. You need to be careful on this because the IRS really holds to the exclusivity of that space as being for business purposes. They have disallowed use of office in the home for offices that had things like Murphy beds that could possibly serve as a guest room. So the office really does need to be exclusively for business purposes. The other exception is it could be a regular place to manage business or meet with clients and patients. This exception was designed to allow lawyers and doctors to meet with clients or patients in their homes. The office could also be a separate structure and used exclusively for business, such as a guest home that's been converted to an office space. Or the dwelling or unit is used for inventory storage and home is the taxpayer's sole place of business. Again, it has to be an exclusive area set aside just for business purposes and cannot have a dual purpose. The office in the home has a gross income limitation. This means that other than the allocable portion of mortgage interest and property taxes, that you cannot deduct office in the home expenses to create a net loss. You can only bring your business net income down to zero. Any additional losses can be carried forward to future years. The costs that can be included for office in the home would be rent, home insurance, repairs, cleaning, gardening, association dues, depreciation, even utilities can be deducted as expenses for office in the home. The office in the home deduction is taken on Form 8829. If you ever look at the bottom of your Schedule C, you will see first that you calculate net income, and then there's a line where the Form 8829 expenses carry forward. That's the office in the home expenses. If you are an employee who works from home, telecommutes, you cannot take these expenses unless it's for the convenience of your employer, which means you cannot choose to work from home. Your employer has to require it due to lack of space for office space or other reasons, but it has to be at the convenience of the employer. Some of those deductions to you as an employee may be deducted on Schedule A versus Schedule C. The allocation for the home office depends on the square footage. If your square footage of your office is 600 square feet and your total home square footage is 2,000 square feet, then 30% of your home is allocated to office space. Therefore, 30% of all of those expenses would be considered deductible for the office and the home. That includes all of those expenses listed before. You may have some direct expenses. For example, if you need to paint or remodel that office, those are direct expenses related just to that room and are 100% deductible and do not rely on the percentage of square footage. However, if you had to do upgrades to the whole home, for example, a new roof, then those would be allocable based on the percentage of square footage. If you are changing the lighting just in the office, then that would be 100% deductible expense because it's just for that home office. But if you had to rework the electrical in the entire house, then a percentage would apply. There are other tax issues that are very important for small business owners to keep in mind. For example, depreciation. Don't forget that depreciation on your financial reporting can occur in different methods: straight line depreciation, units of production, or double declining. But the method that the IRS uses is called a modified accelerated cost recovery system, and it doesn't match financial reporting depreciation. In addition, you may be allowed some bonus depreciation or Section 179. These types of depreciation are not going to match your financial reporting, and they can have a big impact on your taxable net income. So it's important that you speak to a tax consultant about some of these issues. Again, my name is Victoria Koch. I thank you very much for joining us today. For more information, check out iGrow.org.